90% of people who open a trading account will lose their entire deposit within 12 months, not because the market is rigged, not because they're unlucky, because of one number most of them never even calculate. And in the next 60 seconds, I'm going to show you that number and why almost nobody talks about it. Stick with me for this video, and I'll show you 3 things Wall Street pros know that retail traders never get taught. Point 2 is going to hit hard if you've ever thought about using a HELOC or a cash-out refinance to fund your trading account, because that's exactly how people lose their house, not just their portfolio. And around the 70% mark, I'm going to show you the actual math professional risk desks use, the one formula that separates the 10% who survive from the 90% who blow up. This isn't theory. This is the stuff prop firms make you sign an NDA for. Let's start with the number nobody wants to say out loud. Studies out of Brazil, Taiwan, and the US, 3 completely different markets, all found the same brutal pattern. Roughly 97% of day traders lose money over a multi-year period. Not break even, lose. And here's the part that should really scare you. The longer people trade, the more money they tend to lose, not less. Experience doesn't save you. Confidence kills you. So if it's not a lack of experience, and it's not a lack of information, because right now anyone with a phone has access to the same charts as a Goldman Sachs trader, then what is it? It's 3 specific traps, and I guarantee you've already fallen into at least one of them, maybe without even realizing it. Your brain was built by evolution to keep you alive on the savannah 100,000 years ago. It was not built to trade options on Robinhood, and that mismatch is the first reason you're losing money. Here's the specific bug in the code: loss aversion. Behavioral economists proved that humans feel the pain of losing money about twice as intensely as the pleasure of gaining the same amount. So when a trade goes red, your brain doesn't say, cut the loss. It says, don't make this loss real. Hold on, it'll come back. That's why beginner traders do the exact opposite of what works. They cut their winners early because winning feels fragile, they want to lock it in, and they let their losers run because admitting a loss feels like admitting failure. Professionals do the reverse. They let winners run and cut losers fast. It's not a skill. It's a discipline that fights your own biology every single day. Let me give you a real scenario. A guy, let's call him Josh, 27 years old, Toronto, puts $5,000 into a stock. It goes up 8% in 2 days. He panics, sells, books the win, feels like a genius. 2 weeks later, he buys a different stock. It drops 8%. Does he sell? No. He tells himself, it's just a dip. I'll wait for it to recover. It drops another 20%, then 40%. He finally sells at a 60% loss 9 months later, after hoping the entire time. That single trade wiped out 8 winning trades worth of gains. This is called asymmetric loss behavior, and it is, statistically, the single biggest killer of retail trading accounts, bigger than bad strategies, bigger than bad information. Now, here's where it connects to something bigger than just trading. This exact same psychological trap is why people misuse things like a HELOC or a cash-out refinance to fund high-risk trades. I've seen it. Someone pulls $80,000 out of their home equity, a completely legitimate tool when used for renovations, debt consolidation, or buying an investment property, and instead they dump it into a trading account because the market's been going up. The math of loss aversion doesn't care where the money came from. Whether it's your paycheck or your house's equity, your brain still refuses to cut losses at the same threshold. Except now, if it goes wrong, you're not just down a trading account, you've got a second mortgage payment due and no house equity left to fall back on. That's not investing. That's leverage on emotion, and it's one of the fastest ways to go from building wealth to losing your house within a year. So how do professionals beat their own psychology? They don't rely on willpower because willpower fails under stress. every single time. They use pre-commitment. Before they ever enter a trade, they write down the exact price where they're wrong, and they set an automatic stop-loss order at that price. No exceptions. No, let me just check the news first. The decision is made before emotion enters the room. This is exactly the same principle behind a properly structured Roth IRA versus a regular brokerage account. In a Roth IRA, the rules of the game are already locked in. Contribution limits, tax treatment, no early withdrawal without penalty. That structure protects you from your own worst impulses. A brokerage account gives you total freedom, which sounds great until 2 a.m. when you're refreshing charts and about to make a decision you'll regret by breakfast. The traders who survive aren't smarter, they just remove the decision from the heat of the moment. This one is the trap that turns a bad trading month into a financial catastrophe. It's leverage, and specifically leverage that comes from outside the trading account. Here's what almost nobody explains clearly. A non-QM mortgage, that's a non-qualified mortgage for people who don't fit the standard W-2 tax return verified income box, think self-employed folks or investors, can absolutely be a smart tool. It lets real estate investors access capital based on the property's cash flow instead of personal income. Used correctly, that's leverage funding an appreciating cash-flowing asset. But I've seen people take that exact same capital access mindset and point it at day trading. I got approved for $150,000 through a business line of credit. Let me put $30,000 into options this month. That's not the same risk profile. Real estate has intrinsic value and rental income even in a downturn, and leveraged options position can go to zero in an afternoon. Let's talk business credit lines for a second, because this is where I see beginner traders get really reckless. A business line of credit typically requires things like 6 months in business, a certain revenue threshold, sometimes a personal guarantee. Banks build those requirements because they know unsecured, flexible credit is dangerous in untrained hands. Now imagine skipping all of that and just trading on margin instead, where your broker basically hands you 2x, sometimes 4x buying power with a few clicks. No business plan required, no revenue check, nothing. That's the exact same risk mechanism as an undisciplined credit line, free-flowing borrowed money, except with zero of the underwriting guardrails a bank would normally put in place. That's the uncomfortable truth. Margin trading is basically an unregulated business loan handed to you by an app, and most beginners have no idea they're one bad week away from a margin call that can wipe out more than their original deposit. Here's the mechanic almost nobody explains on YouTube. When you trade on 3x leverage, you don't need the market to move 100% against you to lose everything. You only need it to move roughly 33% against you. On 5x, a 20% move wipes you out. On 10x, which some retail brokers offer casually on Forex and crypto, a 10% move against you, and you're done. Not down 10%, done, zero. This is why professional risk desks have a hard rule: never risk more than 1 to 2% of total capital on a single trade, not 1 to 2% of your position size, 1 to 2% of your entire account. If you're putting 20%, 30%, 50% of your account on trade because you feel really confident about this one, you are the 90%. That sentence alone should be screenshotted. So what's the actual fix here? It's called position sizing, and it's mathematical, not emotional. You calculate your position size backward from your risk tolerance, not forward from how much money you have available. Formula: take your account size, multiply by your risk percentage, say 1%, that's your maximum dollar loss for the trade. Then divide that dollar amount by the distance between your entry price and your stop loss. That tells you exactly how many shares or contracts you're allowed to buy. Not how many you want to buy, how many the math allows. Professional trading desks build entire spreadsheets around this one formula. Retail traders skip it entirely and just go with their gut. That's not trading, that's gambling with extra steps. Here's the trap almost every beginner falls into without realizing it. They don't actually have a trading strategy. They have a collection of feelings they call a strategy. Ask a losing trader why they entered a position, and you'll usually hear something like, "It looked like it was about to break out," or "My friend said it was going to pop," or "I saw it trending on Reddit." Ask a professional trader the same question, and they'll give you a specific, repeatable, testable rule, a defined entry signal, a defined exit signal, a defined risk amount, and historical data showing that rule works more often than not over hundreds of trades.
This is where trading risk management for beginners actually starts, not with picking the right stock, but with picking the right process. A system needs 3 non-negotiable components. 1. An entry rule you can explain in 1 sentence. 2. An exit rule for both winners and losers decided before you enter. 3. A position size determined by the math we just covered, not your excitement level. Without all 3, you don't have a strategy. You have a hobby that occasionally makes money by accident and consistently loses money by design. Now let's talk about the silent killer inside the no system trap, revenge trading. This is when you take a loss, and instead of stepping back, you immediately jump into another trade to win it back. Bigger size this time, less analysis, more adrenaline. Studies on trader behavior consistently show that trades placed within minutes of a losing trade have a significantly lower win rate than trades placed after a cooling off period. Your brain after a loss is not in analytical mode, it's in fight or flight mode. And fight or flight is a terrible mental state for reading a candlestick chart. Here's the thing that ties trap 1, 2, and 3 together, and it's the piece almost nobody puts into words. Overtrading is the physical symptom, but the disease is a lack of statistical edge. If you don't know your win rate, if you don't know your average win size versus your average loss size, if you don't know your expectancy, meaning on average across 100 trades, do you come out ahead or behind, then every single trade you place is essentially a coin flip with fees attached. And here's the brutal math. Even a coin flip strategy with a 50% win rate will lose money over time once you factor in spreads, commissions, and slippage. That's the baseline. That's the starting line for a beginner with no edge. You're not starting at 0, you're starting in the negative. Okay, here's the insight that changes everything. The one thing prop trading firms figure out early and retail traders almost never do. Being right about the market matters way less than surviving being wrong. I need you to sit with that for a second. The best traders in the world are wrong 40%, sometimes even 50% of the time. What separates them from the 90% who lose isn't a magic prediction ability. It's that when they're wrong, they lose a little, and when they're right, they win a lot. That's it. That's the entire secret dressed up in complicated language on every trading course that charges $2,000. This is called positive expectancy, and it's the actual formula professional risk desks use, the one I promised you at the start. Expectancy equals win rate times average win minus loss rate times average loss. If that number is positive over hundreds of trades, you make money, even with a losing record on individual trades. If that number is negative, you lose money, even if you win more often than you lose. This single formula is why a trader who's right only 35% of the time can be enormously profitable, while a trader who's right 65% of the time can still go broke if their losers are big and their winners are small. And here's the paradigm shift that ties this entire video together. The 90% aren't losing because they're bad at predicting the market. They're losing because they never calculated their expectancy in the first place. They're playing a game without knowing the score, without knowing the rules, and without knowing whether the odds are even in their favor. This is also exactly why the boring path, a Roth IRA, index funds, dollar cost averaging, statistically outperforms the exciting path for most people. It's not because trading can't work, it's because a Roth IRA has built-in positive expectancy. The long-term stock market has historically trended upward, tax-free growth compounds in your favor, and there's no leverage to blow you up on a bad week. Trading can absolutely build wealth, but only if you treat it like a business with real math behind it, not a lottery ticket with candlestick patterns. So let's make this practical. Here's exactly what separates the 10% who survive step by step. Step 1. Calculate your expectancy before you risk real money. Backtest or paper trade at least 50 to 100 trades using your exact entry and exit rules. If you don't have a positive number, you don't have a strategy. You have a hunch. Fix that first. Step 2. Cap risk per trade at 1 to 2% of total capital. No exceptions, no, this one's different. We covered why. Leverage math is brutal and unforgiving. Step 3. Separate your speculative capital from your foundational capital. This is the one that would have saved so many people I've seen online. Your Roth IRA, your emergency fund, your home equity, your business credit lines, these are not trading capital. These are the foundation of your financial life. Trading capital should be money you could genuinely lose entirely and still sleep fine that night. Step 4. Build in a mandatory cool down after 2 consecutive losses. Close the laptop, walk away for the rest of the day. This single rule alone prevents the revenge trading spiral we talked about earlier. Step 5. Track every single trade in a journal. Entry, exit, size, reason, and emotion at the time. Review it weekly. The traders who improve fastest are the ones who treat their own trading history as data, not as a story they tell themselves about being due for a win. Do these 5 things consistently for 6 months, and you're already operating with more discipline than the overwhelming majority of people who open a trading account this year. Look, nothing in this video is complicated. Position sizing, expectancy, cool-down rules, none of it requires a finance degree. It requires discipline, and discipline is the one thing no course can sell you. You have to actually do it. If this actually shifted how you think about risk, the next video you need to watch is the one where I break down exactly how prop trading firms structure their risk desks day to day, the internal rules that keep multi-million-dollar accounts from ever having a single catastrophic day. It's linked right here to Gesture, to Card, and honestly, it's the natural next step after everything we just covered. And if you want more breakdowns like this, real numbers, no fluff, no get-rich-quick nonsense, subscribe. I put these out every week, and I'd rather have you in the 10% than the 90%.